topics and opinions expressed in the following show are solely those of the hosts and their guests and not those of W4CY Radio, its employees, or affiliates. We make no recommendations or endorsements for radio show programs, services, or products mentioned on air or on our web. No liability, explicit or implied, shall be extended to W4CY Radio or its employees or affiliates. Any questions or comments should be directed to those show hosts. Thank you for choosing W4CY Radio.
Barry G. Fowler, EA, brings you Tax Talk for You right here on W4CY Radio and Talk4 TV. As an enrolled agent and a national leader in tax resolution, as well as trucker, bookkeeping, and tax planning with over 30 years of experience, Barry will break down taxes, bookkeeping, tax planning, and tax relief for individuals and businesses just like you. So let's have some Tax Talk for You with your host, Barry G. Fowler.
Hey, welcome. It's another great Monday to be here and talking small businesses, business taxes, business news, payroll, IRS problems. Hey, you name it. If you got questions, we're going to answer it. We're winding down 2025, and I have clients asking us all the time, what can we do to reduce taxes? There's different techniques to reducing taxes, from investing in new business property or equipment, or spending money. But sometimes we listen to the recommendations other people make, and it doesn't make business sense. So you kind of gotta look at everything with a business perspective. Even if we're winding down the year, and yes, we're trying to save money on taxes. Yes, we're trying to do things that prevent Uncle Sam from getting more money than he should be getting from you. But first thing you want to start with is making sure that you have good, solid, sound bookkeeping. And that's the first place to start. Are you getting all the deductions that you should be getting for your business? Are you capturing every ordinary necessary business expense? I looked at somebody's bookkeeping the other day that came to us and said, hey, can you take over our bookkeeping? And I said, well, first off, let me do a quick review of what you've got and a quick review of where you're at, and to see, hey, maybe you've got a good bookkeeper. And you can continue to rely on them, and then we can do your taxes and do some tax strategies and stuff for you. And we were looking at their books, and we noticed glaring expenses. Now, some of them don't seem to be that big. I mean, simple as telephone expense. Do you have a telephone line in your business? I mean, whether it's a cell phone, whether it's a landline, whatever it is, you're using a phone out there for your business, correct? Well, yeah, that's one place. It was minor. That could be, $500 a month or $400 a month, and it's still a $4,000 deduction that you should be getting out there, or even $6,000 deduction that you should be getting for your business, and you've missed it, which means you're now paying that with after-tax money instead of pre-tax money. And if you are a sole proprietor, not only does that cost you 15.3% for self-employment tax, but it also costs you your federal income tax rate. So depending on where you're at, there could be a total of 35% tax. And then if you have live in a state that taxes you income tax as well, add that to it. So, that was lost money. Now, not that big of a deal, because we could find that and easily make those adjustments. But then we started looking at other expenses, and it just didn't line up. Are you in the trucking business? Maybe fuel expenses aren't where they should be. Maybe they're not looking at your settlement statements and getting all the deductions for insurance or tolls or scales or the other deductions that they may be taking on your settlement statement. And so, you need to be consciously aware of what's on your financials, what's being done for your bookkeeping for it to make sense for you. Some of the little expenses may not seem that little, but they do add up. If you're missing only $1,000 in expenses, again, it costs you money. If you're missing 10 or 15 or $20,000 of expenses because your bookkeeping isn't done right, well, then it's now costing you a lot more money. It's not pennies. It's not nickels or dimes. It's hundreds of dollars. It could be thousands of dollars. So you want to make sure you're getting every single deduction that is allowed by law, and not just jumping to, hey, this is what it is. Now, we've had somebody come to us and said, hey, I was talking to my CPA, my bookkeeper, my tax preparer, whatever, whoever it was, and they told me to go out and buy new equipment before the end of the year. Okay, hey, that's great if you need it, if it's going to help you in business. But just to buy equipment to save money on taxes, now let's just throw out a big number out here, okay? We're going to go out and buy a new tractor for $100,000. And yes, we're going to be able to take that deduction, and maybe we'll be able to take Section 179 on the whole amount. And you are self-employed, so yes, it saves you possibly, $15,300 on your taxes just for self-employment. And then it saves you maybe 20% out there, so another 20,000. So it saves you 35,000. But you're still out 100,000. So net effect, you're out 65,000. Now, if you need the piece of equipment and you're going to buy it in January, why not take advantage of it today? But if you're not in need of this new equipment, or your net income isn't high enough to justify buying this new equipment to get you the full tax write-off, then maybe it's not the right time to do it. Or maybe you're buying a piece of equipment and you're buying some manufacturing equipment, but you're not going to put it into use until the end of next year. Well, it hasn't gone into use, so therefore you're not getting advantage of the tax write-off, because it's got to be put in use as well. So if you're just going to buy a piece of equipment to get the write-off, well, that's not the right way to do it. So it makes the tax person look good because you're going to save money on your taxes. But it surely doesn't help your pocketbook, which is really at the end of the day, the game is to keep as much money for yourself as possible. So maybe that means using retirement accounts. Maybe it means adjusting the way you do business, and instead of being a sole proprietor, maybe you need to be a multi-member partnership. Maybe you need to be a S Corp. All different options to help avoid the payment of certain taxes that are out there. Yes, when you're a partnership or multi-member LLC, you've got to have a guaranteed payment, guaranteed reasonable wage for the owners that actually work in the business. Yes, as an S Corp, you've got to have a reasonable salary for the things that you as a business owner does for the business. Now, there's ways to look at it and analyze your job. Are you doing secretarial work? Are you doing administrative work? Are you doing janitorial work? Are you doing CFO work? Are you doing your CEO work? Are you doing mid-level managers work, or somebody else lower in the food chains work? And then you can say, hey, this is what I would pay for this part of this job, janitorial. This is what I would pay for this administrative part of the job. And this is what I would pay for mid-level management part of the job. And then this is what I'd pay for CFO, CEO work. And then how many hours each week are you doing each one of those jobs? And then you can come down to, hey, this is what my pay should be. And then that there gives you your reasonable salary for the work that you are doing. So if you're a truck driver, you drive the truck, but yet you manage your business, and yet you do administrative work as well, and yet you may do cleaning of your truck, janitorial work. So your salary can be adjusted based on the kind of work that you do. So the one big beautiful bill that was passed here in July of 2025 gives you different options on how to save money on taxes. And year end is a perfect time to make sure that you're taking advantage of everything that was in this law to optimize your income, optimize your savings, make sure that you're taking full advantage of the QBI, qualified business income deduction. And that deduction is now permanent. So, there's different variables that you have to strategically time income expenses for your business, especially at year end. So maybe you have invoices out there and you don't really want to get out and collect them really hard. Maybe you want them to be paid in January instead of paid in December. So you're moving money from this year to next year. There's a lot of different ideas we can come up with for timing, for making things better, and reducing your taxes. And we're going to keep discussing reducing your taxes for 2025 right after this.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. If you owe the IRS or are going through an IRS audit, don't go at it alone. Call Taxation Solutions Tax Relief at 888-930-1016. We are your solution for IRS debts, audits, back taxes, garnishments, liens, and levies. Whether you're an individual or business, you need a solution and a strong, aggressive tax resolution. Don't let the IRS walk all over you. Stop the IRS now. Call 888-930-1016 or go to taxationsolutions.net now for a free, no obligation consultation. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. Here today we're talking about small business news, taxes, payroll, tips, and advice. It's a real nice thing at year end of finding ways to keep more money in your pocket, reduce your taxes, because this is the name of the game, is paying the least amount of taxes allowed by law. And how do we do this and how do we accomplish this, especially in 2025 as the year's winding down? It's the critical time for small business owners to capitalize on significant tax benefits, especially those that were introduced by the One Big Beautiful Bill Act. We were talking about accelerating investments, maximizing deductions, talking about making qualified capital purchases to reduce your taxable income, but only if the equipment is necessary to improve or help your business. If you're just doing it for the tax write-off and it's not going to improve your business, it's not something you would normally buy, there's not a huge reason to do it. So therefore, business-wise, I'm not a fan of just doing that to reduce taxes. I want to see the business reason, the strategy behind it before you make that investment into machinery, equipment, software, whatever it may be that's going to have a large capital outlay. And that's money out of your pocket that you're having to spend to buy this equipment. So make sure it makes business sense. We were talking about strategically timing things for the business. Now, if you operate as a cash business, you really should consider accelerating deductible expenses. If you're buying office supplies anyway, and you can buy office supplies here this month for next year, you can take that as a write-off. Paying future bills come in that aren't due till next year, you can pay immediately and take advantage of maybe the discount on the invoice, because maybe it's 10%, you get 10% off if you pay within the first 10 days or something. You can also take advantage because you get the write-off this year for something you could have waited to pay next year. So it keeps more tax money in your pocket, money that you've already committed to spending. But it's, time is running out to do those kind of things. You've got 16 days left this month to take advantage of paying things early to get the write-offs for 2025. So if you're sitting on a bunch of invoices to pay and you have a large net income, get them paid before year end. Get that check out and in the mail before December 31st so that you can use those expenses to lower your net income. Now, just remember, this is the strategies that you need to use to help lower your net income at the end of the year. And then it would also improve your income so far for 2026 at the beginning. That's the same with what we were talking about in the first segment, is maybe not pursuing collections on those accounts receivables is hard at year end. Granted, you'd rather get the money in because you'd rather have it, and especially before they spend it and can't afford to pay you anymore. But if you're dealing with businesses that you can count on reliably to pay you in a timely manner, then them paying you next year or delaying getting the invoices out so they don't cut you a check before the end of the year might be a strategy you can use here at year end to save yourself money on the tax on that income that's coming in, and then you collect it next year, and then it becomes added to your income there. Now, when you're in business and sometimes you're doing these things to strategically time things, it does lower your net income. So if you're possibly going after a mortgage loan or you're going after other loans for your business, a lower net income isn't always the thing that a bank or lender wants to see either. So you've got to have strategic thinking behind what you're doing, including the timing of the income and expenses for your business. So, that's one of the things that when we talk to people is, hey, yeah, we're talking about it from a tax strategy, but sometimes you've got to talk about it from a business strategy as well, and applying what is projected for the future. So if your projections out to the future is you're going to borrow some money, you may need higher net income in 2025 to get the loans that you need to buy the equipment or get the financing and stuff like that you need for your business as well, or even for your personal. Because we've seen where people have done things to keep expenses or keep the income down so they're not paying as much in taxes, and then they go to apply for a mortgage and they don't have the income to support the mortgage. That sometimes can become an issue for you in your business. You got to put the strategies out there and see, hey, is this going to make sense for me? Is this going to be a issue? Is this going to be a problem? Yes, it's nice to save that 15.3% on self-employment taxes, but then again, you've got the offset of what's going on out there. Now, one of the beauties we were talking about is S corps and partnerships or multi-member LLCs that file as a partnership. You can save money on self-employment taxes based on whatever your reasonable wage is for your business. And we always have to sit down and look at it and do an analysis. Is it right to move from a sole proprietorship, a single member LLC, to an S corp, or to opening a multi-member LLC, maybe a husband and wife LLC that can report as a partnership? And, we always got to look at what that reasonable wage is versus what your net income is from your business, because there's not always a great reason to move and become an S corp unless it's going to do what? Save you money on taxes. And that savings usually comes from self-employment taxes. So if you're netting $100,000 in net income, but your reasonable wage would be $90,000, well, there's only about a $1,500 savings on self-employment taxes. Why bother? Not worth the hassle to go do payroll in a whole new tax form. So you'd have to file 1120S, you'd have to do payroll, you'd have to do 941s, 940s, W-2s. Well, you only save $1,500 and you now have to do all these other things. But if your net income is $200,000, even if your reasonable salary was $100,000, you're talking good savings, 15.3% on about $80,000. That's nothing to sneeze at. That gives you savings. It puts money in your pocket that you're going to be able to keep year after year, as long as your net income is that much higher than what your reasonable wage is. And maybe you're in the trucking business. Maybe a reasonable wage for you to drive a truck for your own business is $50,000, and you're netting $100,000. Well, you get to save 15.3% on the other $50,000. So that $7,500 is what keeps in your pocket, less what the burden is to do payroll and do, file the other tax return. So there are savings out there for you. It works kind of the same way with the multi-member partnership or multi-member LLC, is that you file a partnership return, but you don't have to do payroll. So that's the nice part. It saves you from having to do payroll and payroll taxes and payroll tax forms and stuff. So there's some beauty into that. So that multi-member LLC filing as a partnership can save you even more money depending on your reasonable wage that you've got to have. And then that reports it as a guaranteed payment versus actually having to do payroll for you and whoever else is a member of the partnership with you. So some of those things are things that you should keep in mind when you're doing an analysis, especially coming here at the end of the year, moving into next year, because you only have till March 15th to make that election for S Corp status for 2026. Hey, we were speaking about payroll and small business payroll. We're going to keep talking about payroll and things you've got to do for when you do payroll right after this quick break.
We have only scratched the surface of today's show. Please stand by, as Barry G. Fowler will be right back with Tax Talk for you. As an owner-operator, you already spend too much time away from your family. Trucker Tax Tools handles all your bookkeeping and taxes no matter what level trucker you are. Life on the road can be taxing, but that doesn't mean that your wallet or time with your family should suffer. Trucker Tax Tools makes your life run smoothly. Go to truckertaxtools.com for a free guide that will give you the tools to never worry about your taxes again. Call Trucker Tax Tools 877-966-2477 or go to truckertaxtools.com now and let the experts keep you trucking. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Welcome back. Payroll. Who likes payroll? As an employee, you love payroll. That's how you get paid. The amazing part is you don't feel the pain after your first check or two. And what do I mean by pain? Well, if you take my kids, for example, their first job when they got out, they got a check. They may have been working for, let's say, $10 an hour, and they worked 20 hours, and they calculated, I should be getting $200. Yeah, then they saw the payroll taxes come out. And they went, what is this? It's the government's way of taking money and enforcing collections. That's what it is. And that first check, it was painful. It may have only been, $15 coming out of their check for Social Security and Medicare, but it was painful to them because they were counting on that $200, and now all of a sudden they figured out the government's taking their money. In their case, they were like, it's stealing. They're stealing our money, Dad. Well, yeah, it's probably stuff you're never going to see in your lifetime, or you're going to get a very little of it back. It would be better if we all invested our own money and saved for our own retirement and never touched it, but that just doesn't happen. Ask people who have 401ks that they've withdrawn from to do certain things, to pay bills or whatever it may be, or they cashed out IRAs and paid the penalties. So we all know how life goes, but it is the world we live in. Payroll, nobody likes doing as an employer. Managing payroll taxes to be paid by you, the employer, is one of the most complex aspects of running a business, but it is a responsibility that every business owner must and has to get right. We're going to go through some things that happen with payroll. We're going to go through some good, bad, and ugly with payroll, but let's just start with the basics of payroll. There are different types of payroll taxes that you have to pay in. And we all know the federal income tax that is withheld from your employee's wage based on their W-4 form. You, the employer, are responsible to withholding and remitting this amount to the federal government. And there's no matching to this one. This is strictly withheld from your employee's check. Then FICA, Federal Insurance Contributions Act. It's a shared responsibility between you, the employer, and the employee, funding Social Security and Medicare. The Social Security tax for both you, the employer, and the employee is at 6.2%, which totals to 12.4 on wages up to the annual limit, which for this year, 2025, was $176,100. So yes, you pay as an employer 6.2%. The employee pays as well 6.2%. So you're withholding from theirs and you're contributing from the company. So that's part of cost of employment. Medicare tax. Both the employer and the employee each pay 1.45%, a total of 2.9% on all wages. Now, employees who earn over the $200,000 annually must pay an additional 0.9% towards the Medicare tax. The employers don't have to match that. Now, when we talk about trust funds, we talk about the money that you're withholding from your employees' check. So that's the federal income tax, and that's your FICA tax, Social Security, and Medicare that you withhold from their check. So remember that that's a trust fund, meaning that that money was pulled out of their check in trust to you to pay to the federal government. Then, as an employer, you're also going to be responsible for the federal unemployment tax. It's paid solely by you, the employer. So when you're doing hiring, you've got to think about what taxes the company's paying in addition to what you're paying your employee, because that is the cost of employment, at least part of it. So the federal unemployment tax is paid solely by you, the employer, to fund federal unemployment programs. That full rate is 6% on the first 7,000. Yeah, you got worried there, didn't you? 6% on whatever you're paying them. No, it's only on the first 7,000 of each employee's wages. But you can get a credit for paying state unemployment taxes timely. Typically going to reduce the effective rate down to 0.6%. So yeah, we sweat it out when you start thinking about 6% of my employees' wages. Oh my gosh. And then you find out it's only on the first 7,000. Then you find out you can reduce it down to about 0.6 if you're paying your state unemployment. Now, state unemployment and local taxes vary significantly by state location. Also based on your track record and history. If you don't have a lot of hiring or firing of people, then your state unemployment rates can keep coming down. Here in Texas, it starts like at 2.9%. It can get down to like a 1% based on the first $9,000 of wages. And then after that, there's no tax. So it's all the things that we've got to think about is, again, that, federal withholding, that FICA tax matching the employer side, federal unemployment that the only employers have, and then state and local taxes, which could be state withholding, and then state unemployment taxes as well. And so when you're looking at it, you've got to go through and figure this out. Now, the state unemployment taxes is only taxed to the employer, is not taxed to the employee. So again, that adds to the cost of having an employee. And then if you offer any benefits to the employee, that also adds to the cost of the employer. So you can sit down and figure out what your cost is of each and every employee that you have using the Social Security, Medicare tax, your federal unemployment tax, and then your state unemployment taxes as well. Now, some of the things you as an employer really got to sit down and look at and make sure you're responsible, because a lot of people want to classify workers, and this is really big one, worker classification. Want to classify workers as independent contractors because then they don't have to pay Social Security and Medicare matching. They don't have to pay federal unemployment or state unemployment on them. So it does reduce the cost of having that worker working for you if they're an independent contractor. But you've got to make sure you're looking at what classifies somebody as a worker, as an employee versus a contractor that's out there. And maybe we'll do that next week in the next episode, is talking more about worker classification. You as an employer are responsible for withholding and making payments. So you got to calculate and withhold the correct amounts from your employees' checks. And then you got to make timely deposits to the IRS and timely deposits to state agencies. These payments that you're making to the state and to federal are typically made either monthly, semi-weekly, depending on the tax liability. And then you have to do it via electronic federal tax payment system. And you may hear it as the EFTPS system, that you would have to make the payments through that system. Then you've got to report it. You got to file the required tax forms quarterly, 941s, annually, 940 W-2s. So you've got to make sure you're making those filings. Then, if you're filing for the state, you may have quarterly filings with the state unemployment office. And then when you file your W-2s, you got to do the state reporting as well. And then, your 940, which is your federal unemployment tax, you've got to make that reporting in January of every year. And then maybe you're a small business and you only have 944 annual filing. Don't get all these things confused. Make sure you're reading your documentation and your letters from the IRS that says, hey, this is how we've got to file. As well as in January, the IRS sends you a letter that says, hey, this is how you've got to make your deposits for federal payroll taxes as well. So you got to read. A lot of this stuff is read. Hey, we got to take a short break. We're going to continue talking about payroll taxes, but we're going to talk about what happens if you don't make these payments or meet these deadlines. And we'll do that right after this.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Stop spending time doing paperwork. Go to truckertaxtools.com, a solution built specifically for truckers. Truckertaxtools.com makes your life run smoothly. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. Finally got some question came in, and the question is I'm a sole proprietor, single member LLC, and I don't have employees. Do I need to do payroll for myself? No. So if you're a sole proprietor, you're a single member LLC, and you have no employees, you do not manage payroll taxes in the traditional sense, meaning you don't do payroll. Single member LLC, no employees, there is no payroll. You pay self-employment tax at the time of filing your federal tax return, which covers both the employee and employer portions of Social Security and Medicare, totaling that 15.3%. However, you do need to make estimated tax payments as off your 1040 so that you are paying taxes in quarterly. But there are no 941s, 940s, W-2s, or anything else to file if you have no employees. So your self-employment tax, again, is reported on your net income off your Schedule C of your personal tax return on the 1040. So payroll is if you have employees, or maybe you're an S Corp and you have to run payroll, or a C Corp and you have to run payroll. You've got to file all those forms. Now, what happens when you don't do this? Taxation Solutions has worked with many companies that have failed at this one job. And that's doing payroll tax returns. That's doing their filing of their payroll taxes and paying it in. Now, remember we talked about trust fund. Trust fund is the money that you withhold from your employee's check. So federal income tax you withhold. Social Security and Medicare that you withhold from their pay are considered to be trust fund. And then you have the company taxes, the federal unemployment, state unemployment, your Social Security and Medicare that match. Excuse me. See, I get choked up over people that don't pay their payroll taxes because this becomes a nightmare. A nightmare. See, when you're withholding money from your employee's check, the IRS is trusting the fact that you're going to pay that back to the IRS timely, almost immediately. We tell most of our employers that if we do payroll for you, we're going to do your payroll and immediately transfer the money to the IRS for the payroll taxes, both sides, because, one, we don't want you to wait till next month and then you can't afford to do it. But when you get into that situation, sometimes people find it the easiest thing to do is to not pay the payroll taxes. And then you have a problem. And then once the IRS catches on that you didn't pay your payroll taxes, guess what? No, they're not coming out and arresting you immediately. No, they're not going to come out and arrest you for doing this unless you've committed fraud. What they're going to do is hit you with the trust fund penalties. They're going to hit you and the business with penalties and interest. They're going to hold you, the business owner, and any signers in the business liable for these taxes because you pulled it out of your employee's check in trust to send to the government, and you failed to do your job. And therefore, they hit you personally for the trust fund taxes. They hit your business for the trust fund taxes. They're going to set you both up on a payment plan to pay back the trust fund taxes and the other taxes. So you're going to see, if you got hit with trust fund penalties, you're going to see you making payments on the trust fund part of the tax personally, and your business making payments on all the taxes for the business. So you're held responsible. Now, that doesn't mean that, hey, they've double dipped. No, it just means they're finding ways to collect the money from you. Even if you and your business are running together, they're finding the way to get the money from you. Do you ever hear the term, can't get blood from a turnip? Well, I think this is where they're getting blood from a turnip. They're milking it both ways, coming and going. Now, maybe you're not a business owner and you were a signer on the checking account. You were a manager. You had responsibilities. They come after you as well. And now they're collecting from you for something that you had no access to additional money for. You weren't the business owner, but you were considered to have responsibilities in making sure those taxes were paid and paid timely. And so they're holding you accountable. Hey, Marjorie, your question was right on. You as a manager are being held liable for trust fund penalties that the company chose not to pay. Yes, you're held responsible for those. Now give us a call, 888-930-1016. Let us help you through that. Let us find ways to maybe resolve this issue with the IRS and get you out from underneath those trust fund penalties, especially if you didn't have representation, or maybe the company said they were going to represent you and they did a terrible job of representation and you got stuck right along with the owners of the business for the trust fund penalties, and now the IRS is collecting from you. We need to get this stopped, and we need to either prove to the IRS that you didn't have that responsibility or you couldn't make those decisions, or, hey, maybe you just can't afford to make these kind of payments and we need to get this off your back, or we need to work with your employer to get these things paid and reimburse you for the expense you're having to go through for them. See, this is a bad thing. We represented a client who actually managed a bar, he came to us and got hit with trust fund penalties for his former employer. He hadn't been with his employer for a couple of years. And before the third year was up, he got hit with responsibilities for trust fund penalties because he was a signer on one of the accounts. Now, we were able to go back in and prove that he only signed on this small cash account, and they only put money into the account enough to cover the bar tab with the deliveries and everything happening at the bar, so he could cover just that. It was basically a petty cash account, but they bought all their bar supplies and everything there for the restaurant, the bar and grill, and he had no other responsibilities besides that. He was never even made aware of, didn't know anything about payroll, never even processed payroll, never was in the corporate office. And they did everything at the corporate office, at the corporate level, but not at the individual bar and grill that's there. So maybe, Marjorie, that is your case as well. We can look at it and do the analysis to make that decision, what's the best thing to help you. But when you're in this situation, it can be really devastating because, they hit you with taxes for not paying timely, not filing if you didn't file the 941s, you name it, the penalties and interest continue to accrue. And, it's hard enough when you're running a business and you're behind as it is on bills and you're behind on payroll. This just compounds the issue. But first thing we want to do is make sure we get you back in compliance, making sure those taxes continue to be paid. And if any way at all, to get those trust fund penalties paid off so that it gets off your personal record as quick as possible. Or if you have other employees on there that are being hit with trust fund penalties, we can get that off their back as well. So the IRS is looking for as many backs to get themselves attached to. And, unfortunately, this is just the way things will go. This is a hard part of doing payroll taxes and doing payroll. I've seen many people go it alone. The fees that you're going to get charged seem to be a little bit high, but the fees that you get charged are well worth it because they make sure you get your quarterly filings done. They make sure you get your annual filings done. They will make sure that you're making the deposits properly for payroll taxes. Now, if you don't have the funds there's nobody can help you. Okay. Really, just there's nobody that's going to help you be able to do that. So you're going to want to make sure that, hey, the funds are there for your business so that when you do pay payroll, the taxes are being paid and everything is being done timely. So those are the kind of things that you need to do when you're doing payroll out there and making sure things are there. Again, if you get hit and you haven't paid your payroll taxes, you haven't kept it to date, maybe even with your federal income taxes, call taxationsolutions.net tax relief. Again, it's taxationsolutions.net tax relief. Get the relief from the taxes that you deserve to stop the IRS in the tracks, stop their collection activity here today. Don't let them trample all over you because you don't know the rules and regulations and the laws that they've got to follow and you should be following. Call us at 888-930-1016. Again, 888-930-1016. Man, time flies when we're having fun, doesn't it? Talking taxes. Hey, next week, we're going to continue talking about year end and taxes and what you can do to help your business, help yourself. Or maybe we'll even continue talking about what you should do in 2026 to help improve your business and make yourself a bigger success. Hey, but as always, you should follow us over at taxtalk4u.com. So you never miss an episode. And if you do, you can get our podcast over there at taxtalk4u.com. follow us on Facebook, both at Trucker Tax Tools, Taxation Solutions, Tax Relief, and Tax Talk for You. But never miss an episode. We're always here Mondays, 10 a.m. Eastern Time on W4CY Radio, W4CY.com. Don't miss us. And if you do, check our podcasts out. We're on all the major podcasts. Again, it's taxtalk4u.com. And we'll see you next week. Have a God blessed and glorious week.
Are you an individual or business that wants to understand taxes and how they affect you? Are you looking for specific tax advice for self-employed, business owners, and truckers? Are you behind on taxes and your bookkeeping? Are you dealing with the IRS and ready to have some relief? Then you need Tax Talk for You, hosted by tax and trucker expert Barry G. Fowler, EA. Tune in 10 a.m. Eastern Time every Monday right here on W4CY Radio and Talk4 TV. Don't forget to check this and past episodes at taxtalk4u.com. See you next week at W4CY.com.